Welcome to Breaking News to Trading Moves. And welcome to the debate. If you trade breaking news to catch trading moves, you know this exact scenario.
Oh, definitely. We have all been there.
Right. Imagine walking through a dense forest at night. You are surrounded by darkness, completely unsure of your footing. And then suddenly, you find this perfectly paved, brightly lit path. It looks incredibly safe.
Right. It has clear markers. You can clearly see the direction of travel. And, there's a psychological comfort in numbers.
Exactly. Everyone wandering in the woods naturally gravitates toward it because the alternative is navigating the unknown. But because every single person is walking down that exact same brightly lit path, well, that is exactly where predators notice that they're traps.
Yeah, a very stark visualization of a crowded trade.
The visibility provides this illusion of safety, but in reality, it is drawing the danger right to you. So today, we are examining the concept of the obvious trading setup. A stock has a clean chart breakout, a strong news catalyst just hit the wires, the volume is surging, and social media is just going crazy.
It makes a trade feel guaranteed. Your brain is screaming at you to buy so you do not miss out on the momentum.
But our central question is this: does the very visibility of a perfect setup make it an inherent trap? Because I look at a perfectly clean breakout with massive retail hype, and all I see is danger. I argue that when a setup becomes too visible, the sheer weight of crowded positioning, emotional entries, and predictable order flow makes it structurally fragile.
See, I come at it from a different way. I approach the exact same chart, but I draw a completely different conclusion. That visibility, the high volume, the clear breakout, those are exactly what momentum looks like.
But it is a trap.
The chart is not the trap. The trap is poor execution. If you enter late or if you manage your risk exactly like the rest of the nervous crowd, you are going to get hurt. But that is a failure of your strategy, not a flaw in the setup itself.
Okay, let us break down the actual mechanics of why that visibility is so toxic. Because it is not just about psychology, it is about plumbing.
Right, the actual order flow.
Let us put a hypothetical scenario on the table. Imagine a tech company just released an earnings report that completely crushes expectations. The stock is rallying, and it is approaching a massive round number resistance level at exactly $100 a share.
The classic whole dollar breakout. Every single trader on Earth has that level marked on their screens.
Exactly. And because everyone sees the exact same $100 line, the retail crowd rushes in right as it crosses. Now, every single one of those buyers needs a safety net.
They need a stop-loss order to protect their capital if the trade reverses.
Right. So they look at the chart, they see $100 as the new floor, and they place their stop-loss just a few pennies below it, say at $99.80.
Which makes complete logical sense on the surface. You want to cut your losses if the breakout fails and falls back below the key level.
On the surface, yes, but let us talk about what a stop-loss actually is. A stop-loss is an automated market sell order waiting to be triggered.
Right.
So at $99.80, you now have tens of thousands of sell orders sitting at the exact same price point. This creates a massive mechanical vulnerability. Larger market participants and high-frequency trading algorithms can essentially see that cluster of liquidity.
It becomes a target.
Placing your stop right below that obvious breakout line is like standing on a trapdoor along with 1,000 other people. The algorithm does not have to fight the entire market. It just has to pull the lever.
When you say pull the lever, you are talking about the liquidity trap, the stop hunt.
Precisely. The algorithm sells just enough shares to push the stock price down a few cents, specifically to hit that $99.80 level. The second the price touches that number, the trapdoor opens.
Wow. And all those thousands of retail stop losses trigger simultaneously?
They become market sell orders, flooding the order book. The price drops like a stone to $98. The algorithm then simply buys back the shares at the new lower price, pocketing the difference. Meanwhile, the retail crowd is left wondering why their perfect chart suddenly collapsed.
The predictability of the crowd drew the attack.
Exactly.
I hear you, and I completely agree with your assessment of how stop clusters function mechanically. A dense cluster of stop-loss orders is an absolute magnet for algorithmic trading. That is just the mechanical reality of modern markets.
It is structurally weak.
But here is where we diverge. The existence of that trapdoor is a reason to adjust your risk management, not a reason to run away from the trade.
Wait, so you are saying the exact mechanism designed to wipe traders out is something you just accept as part of the process?
Well, not accept passively, but navigate strategically. Let us go back to your $100 breakout example. A disciplined trader looks at that exact same chart and asks a crucial question.
Which is?
They ask, where is the nervous money placing their stops? They identify that $99.80 level. They know the algorithms are going to hunt for liquidity right there. So instead of joining the crowd on the trapdoor, they determine a more logical, less crowded level for their own risk.
Like moving it further down the chart?
Exactly. They might size their position smaller so they can afford a wider stop. Maybe they place it at $98.50, hiding it just below a structural moving average, rather than right under the obvious breakout line.
I suppose that makes sense.
Or better yet, they anticipate the stop hunt entirely. They wait for the algorithms to push the price down, trigger the crowd's sell orders, and they place their own buy orders exactly where the panic happens. They buy the unnatural dip. If you know how the plumbing works, you can use the trap to your advantage.
I see why you think that, but let me give you a different perspective. You are stepping over the trapdoor, sure, but that assumes the herd's behavior does not compromise the overall structural integrity of the move itself.
What do you mean?
Even if you survive the stop hunt, you are still dealing with the reality of who is actually driving the price action. When a trade is that obvious, the composition of the participants changes. You are no longer riding alongside convicted long-term capital. You are riding alongside a nervous crowd.
I would argue that strong news catalysts and high relative volume drive genuine, durable price action. When a company changes its financial outlook, that brings in real institutional capital.
But institutional capital operates completely differently than the crowd. Let us look at how those two groups interact. The momentum you see on the screen in these highly visible setups is often built entirely on weak hands.
The retail buyers.
Right, the late buyers piling in after seeing it trending on social media. They are terrified of losing their unrealized gains. If the majority of the volume is driven by emotional traders, the market structure becomes completely fragile. A tiny dip causes widespread panic.
Because they lack conviction.
Exactly. The momentum you are tracking is an illusion created by emotional overcrowding.
That is a compelling way to view market psychology. But you cannot discount the reality of institutional participation. When an earnings report completely surprises the market, real capital has to reprice the asset. That is not an illusion.
It is still dangerous.
But it is a tangible shift in valuation. If you avoid these trades entirely, simply because retail traders are talking about them online, you are sidelining yourself out of fear. You are missing out on valid, high-probability opportunities because you are overly focused on who else is in the room.
But the presence of that crowd changes the behavior of the institutions. It is not just that retail traders are in the room, it is that institutional capital actively uses the retail rush to their advantage. Let us trace the order flow.
Okay, trace it.
Imagine a large fund bought millions of shares of this tech company weeks ago at $70. Now the news breaks, the stock hits $100, and everyone on social media is screaming to buy. The fund wants to take profits.
Right.
But if they try to sell 1 million shares on a quiet Tuesday, the sheer size of their order will crush the stock price down to $90 before they can finish selling.
Yeah, large orders have a market impact. They need demand to absorb their supply.
Exactly. They need exit liquidity. And what better exit liquidity than a frenzy of late-arriving retail buyers blindly buying the $100 breakout? The institutions sell their massive positions directly into the buying pressure of the crowd.
Ah, I see.
That is precisely why you see these flawless, textbook breakouts suddenly stall and reverse. The big players are distributing their shares into the strength provided by the obvious setup. Buying that breakout is just volunteering to be the bag holder for smart money.
Which brings us to the friction test that every trader must run before they ever touch the buy button. I completely agree that you cannot just buy a stock because the chart looks pretty and the volume is high. If institutional money might be using the retail rush as exit liquidity, you have to protect yourself.
So what does that checklist actually look like in practice?
You have to ask yourself a series of cold, unemotional questions. Is this move already extended? How many days has it been running before this breakout?
Right. Is the volume still accelerating, or is it starting to trail off just as the price hits resistance? Is the underlying news catalyst already fully priced in by the market? Does the mathematical risk justify the potential reward? These questions protect the trader from the emotional entries you are describing by forcing rational behavior. Exactly. If a trader sees a breakout but asks, "Am I late to this party?" and the honest answer is yes, they simply do not take the trade. The checklist forces rational behavior in a highly irrational environment. I hear your point about discipline, but if we are being honest about that checklist, applying it rigorously almost always leads to a single conclusion. Which is? The first breakout of an obvious setup should be skipped entirely. How so? Think about it. If you ask, is the move already extended on an obvious setup, the answer is almost always yes. It had to be extended to become obvious to the crowd in the first place. By the time it hits everyone's radar, the initial move has already happened.
Well, that is a fair point.
And if you ask, is the news priced in? Well, if every financial blog and social media account is talking about it, the market has certainly priced it in. Therefore, if you actually follow your checklist, you can never play the initial obvious breakout.
I actually do not disagree with that conclusion, and that is a perfectly valid application of the checklist.
Wait, so you can see the initial setup is a trap?
I can see that buying the exact moment of maximum hype is dangerous, but that does not mean you ignore the asset entirely. The underlying catalyst, the strong news, the massive volume, is what made the stock worth watching in the first place.
So you keep watching it.
Yes, you use the obviousness of the setup to put it at the very top of your watch list. But your actual execution happens at a different, more advantageous moment. You wait for the retest.
Explain the mechanics of the retest for those visualizing this.
Let us go back to the $100 line. The stock breaks out to $102, then the institutions start taking profits, and the price drops back down to test the $100 level. This is the retest.
Okay.
If the price holds at $100 and begins to bounce, the trade becomes structurally stronger.
Because the weak hands have been shaken out.
Exactly. The late retail buyers who panicked during the drop are gone. The institutions who needed exit liquidity have finished selling. The order book is clean again. By waiting for the retest, you are letting the market clear out the fragile participants.
Missing that first explosive move is simply the price of discipline.
Precisely. You wait for the dust to settle, and then you enter with the clear, defensible risk profile.
Let us talk about what happens if the dust settles and the chart is broken. What if that retest fails? Because to me, that is where the real mechanics of the market reveal themselves.
Right, a failed breakout.
If the stock drops back below $100 and keeps falling, that initial obvious setup becomes a devastating trap for the eager buyer. But for traders who look to short the market, these failed obvious trades create some of the most powerful opportunities available.
Because you are capitalizing on the unwinding of a crowded position.
Precisely. Let us walk through the downside mechanics. The stock breaks $100, hits 105. Everyone buys. Then it fails and drops to 95. Think about the psychology and the plumbing of the people who bought at 105.
They are in pain. They are watching their account balances shrink.
Exactly. Eventually that pain reaches a breaking point and they have to sell to stop the bleeding. A short seller looks at that failed breakout and anticipates that forced selling. When the trapped buyers finally hit the sell button to exit their losing positions, it creates immense downward pressure.
Right, a cascade of selling.
A short seller borrows shares and sells them, riding that wave of mechanical panic downward. The unwinding of a crowded long trade provides incredible, predictable downward momentum.
It certainly provides downside pressure. But I need to jump in here with a massive warning about the mechanics of shorting. Shorting a stock solely because it is a failed, crowded retail trade is extraordinarily dangerous.
Why?
If the buyers are trapped, the selling pressure is mathematically guaranteed to happen eventually.
Eventually, yes, but the market can remain irrational far longer than a short seller can remain solvent. Just because a trade is crowded with retail buyers does not guarantee it will fail immediately. Sometimes a crowded trade can continue pushing higher simply due to sheer volume.
And if you step in front of that to short it,
You open yourself up to a short squeeze.
walk us through how a short squeeze actually functions in this context. It is the exact same crowding problem we discussed earlier. Just flip to the other side of the ledger. Let us say everyone sees the failed breakout and thousands of traders decide to short the stock. Now the downside trade is incredibly crowded.
Right.
To open a short position, you have to borrow shares and sell them, with the promise to buy them back later. To close a short position, you literally must buy shares.
So a short seller's exit strategy is a buy order.
Exactly. Now, imagine the stock suddenly ticks upward on a piece of unexpected news. The short sellers who jumped in start losing money. To cut their losses, they have to buy shares.
And that forced buying acts as artificial demand.
Yes, shooting the price higher. This triggers the stop losses of the next layer of short sellers, which are also buy orders. It becomes a violent chain reaction of forced buying. The price skyrockets and the short sellers are completely trapped. That is the mechanism of a squeeze.
You cannot just step in front of a freight train because you think there are too many passengers on board.
Exactly. You need absolute proof that the engine has stalled.
So what does that proof look like? How do you avoid the squeeze?
You need to see the structural breakdown. You need to see the failed breakout followed by lower highs. And you need to see the volume expanding on the downside, proving that institutional capital is abandoning the asset. You never commit capital blindly based on a narrative. You wait for the confirmation in the price action.
Which really brings us back to the core vulnerability of the obvious setup. Whether you are going long on the breakout or trying to short the failure, the visibility of the trade dictates the behavior of the participants.
That is true.
The more visible the trade, the more predictable the participants become. And in financial markets, predictability is routinely punished. If everyone knows exactly where the stop losses are placed, those stops will be hunted by algorithms. If everyone buys at the exact same technical breakout line, the ensuing structure is inherently weak because it is built on emotional momentum rather than lasting conviction. Crowds create emotion. Emotion creates rushed entries, and rushed entries turn theoretically strong ideas into terribly weak trades. The visibility itself is the vulnerability.
But again, I must emphasize that the visibility only creates vulnerability for those who lack a strategic framework. Yes, the crowd becomes entirely predictable, but the disciplined trader uses that predictability to their advantage.
By understanding the mechanics.
Right. They understand the mechanics of the order book. They ask themselves, where is the crowd positioned and what mechanically happens if that level breaks? By answering those precise questions, they define their own risk.
They define it outside the obvious zones?
Exactly. They do not avoid the high-volume catalyst-driven stocks simply because they are popular. They engage with them systematically. A brilliant thesis still requires a precise entry, a logical stop loss hidden from the algorithms, and a realistic target based on market structure. The elements that make a trade obvious are simply the raw materials of opportunity. It is up to the trader to manufacture a good trade out of them.
It seems we are looking at the exact same phenomenon but drawing very different boundaries around the nature of risk. I maintain that obvious trades act as magnets for crowds, making them structurally fragile and heavily prone to algorithmic liquidity traps. The sheer weight of emotional, late-arriving retail capital corrupts the chart pattern.
And I maintain that the elements making a trade obvious are valid essential markers of momentum. You cannot have a sustained trend without them. They require careful execution, rigorous friction testing, and strict discipline rather than wholesale avoidance. The danger is in the mirror, in the trader's lack of discipline, not in the chart itself.
Yet, despite our different angles, we both converge on a very specific necessity. You have to identify where the crowd is positioned. We both agree that a trader cannot simply look at a chart in isolation, assuming the lines represent absolute truth.
Absolutely.
Anticipating the plumbing of the market, what happens when a popular level breaks and stops are triggered, is absolutely crucial for survival.
Whether you use that information to avoid the first explosive breakout entirely, to place a wider stop loss safely away from the trapdoors, or to prepare for a calculated short selling opportunity upon a confirmed reversal, you must deeply understand the psychology and positioning of the other participants.
A good idea alone is never enough in this environment.
It demands flawless execution.
Great traders look far beyond the setup itself. They do not just see the price, they see the unseen mechanics of the market. They visualize the clusters of stop losses sitting just below the obvious lines. They anticipate the algorithms hunting for liquidity.
They recognize the weak hands holding on to fragile gains, ready to panic at the first sign of trouble.
Forest and the brightly lit path we started with. The path is obvious. The crowd is rushing down it, convinced of their safety. But true survival in the markets requires the patience to stand quietly in the trees.
Just watching the flow.
You watch the flow of the crowd. You wait to see where the trapdoors open and the traps are triggered. And you only step out onto the path when the danger has passed and the ground is truly stable. Patience ultimately may serve as your strongest, most reliable edge.